Hello, everyone. Today, I want to talk a little bit about the VIX index because, like many things on Wall Street, the VIX index is very misunderstood. So, let me get right into it. Well, why is it misunderstood? Well, first of all, it's called the volatility index, but it's really not a volatility index. Volatility is a measurement that goes backwards, it's a fixed number, it's a known number. The VIX is an implied volatility index. This is the market's prediction of what the volatility is going to be in the future. Now, this is run by the Chicago Board of Options Exchange, SIBO. Check out this site here if you want to learn more about it. It's a pretty cool site. And there's actually a lot of VIX indices. Let's see, SIBO. They've created a lot of different products because they make money when people trade on them or when people trade these things. So lots of people, as we know, like to trade the VIX, but there's a VIX on oil, there's a VIX on small cap. So the best way to look at the VIX, in my opinion, is it measures the price of insurance. Now, the VIX has been called the fear index. If the market's really blowing up, the VIX goes higher. Well, what is this? It's a measurement of how much portfolio managers and traders and investors pay to get their insurance. If you're an institutional money manager and you have a big portfolio of stocks, say you got $1 billion and you got 50 stocks in there, and you think the market's going to go down, well, it doesn't make sense to sell all those stocks. You're just going to have too much operational issues. You're going to be paying a ton of commissions. You might have some mandates from your clients that you have to keep your portfolio in certain percentage of stocks. Usually it's about 95. So what do? If you start to panic, you go out there and you buy puts. Now, if the market goes lower, the puts go higher. So this is what we call a hedge. And in a perfect world, the hedge would go up the same amount of value as the portfolio goes down. Now, so the VIX measures how much it costs to buy these options. Now, I'm not talking about the price of the actual option. I'm just talking about something that gets caught up within the premium. Um, so when the market's really blowing up, portfolio managers are willing to pay higher prices to get insurance. Just suppose you didn't have theft insurance on your car and then your neighbor's car got stolen. Well, you would be willing to pay a higher premium for that insurance than if your neighbor's car didn't get stolen. Okay? So it's been called the fear index, and that's why. But that's kind of a misnomer because it could also be called the euphoria index. This is the very end of the bull market that ended in December, which started whenever 10, 12 years ago. Now, when the market's at a very top, there are investors who are euphoric and they're afraid of missing out. Where is my darn arrows? They just changed the arrows on here. Arrow mark up. Yeah, whatever. We don't really need it. Not a big deal. I'll just use this. So this is the very end of the bull market, and look at how the VIX just skyrocketed. So you can, I guess, you can call VIX the fear index, but you can also call it the euphoria index. Now, right when this was happening, there was an article in Bloomberg that talked about how the rules of the VIX had changed. Anytime you see something where they say the rules have changed or this time it's different, well, that's when you have to pay attention because there's nothing new under the sun. The person who wrote this article just didn't understand what the VIX was, and they didn't understand how the VIX could be going higher if the market is going up. Well, just like people will pay a higher premium to get into insurance if they think that the market's going to go down, people will pay a higher premium if they're euphoric and they think the market is going to keep going up. So two things there. One is the VIX is not a volatility index. And the SIBO named it that. So I don't I'm not surprised that people are confused and call it the volatility index. But again, a volatility index is a known number. It's a measurement going backwards. The VIX predicts what the market's going to do going forward. Or I shouldn't say that. The VIX predicts how much people think there's going to be volatility. Now, in terms of, does it give you any kind of insight into the future of the where the market's going to go? The answer is no, absolutely not. Laszlo Barini is a famous money manager, and years ago he said trying to get a market preview from watching the VIX is like trying to predict who's going to win a horse race by being at the finish line and watching which horse goes across first. It's a concurrent, concurrent, concurrent. It's not a predictive thing. It's something that occurs concurrently. Hey, man, this isn't an English class, all right? so, anyway, I just wanted to point that out. Not giving any trading advice or anything like that. Just to help you learn a little bit about what the VIX is. There's a lot of different things on Wall Street that people don't understand, and this is one of them. So, just to sum up before I go, the VIX is not a volatility index. It is an implied volatility index. The easiest way to look at it is it measures the price of insurance that people are willing to pay to get into positions when they go into the options market. If the market's really blowing up and we got a lot of fear, well, the price of or the level of the VIX is going to move higher because investors and traders are willing to pay more to get into positions to hedge themselves. In other words, to go buy puts, than if the market was just flat. I mean, if the market's flat or it's just kind of meandering along, there's not going to be any fear or euphoria. Well, if the market really starts to blow up, there's going to be fear, and that's going to cause investors to pay more or have investors be willing to pay more. And because you have this big rush into the market of all these scared investors who want to buy puts, and you have all this competition between them and people outbidding each other, well, the VIX is going to go up. But the VIX could also be called the euphoria index because when the market's in a bubble or when the market's at a top, investors or traders are going to pay more money or they're willing to pay higher levels to get the insurance of not missing the move higher. So the VIX can be called the fear index, but it can also be called the euphoria index. It's not a volatility index, it's an implied volatility index. And in my opinion, and the opinion of some very savvy traders I know, there's no forecasting value in watching it. Now, I know people trade it, and that's fine if it fits what you do. But I just want to have a little educational lesson. And if you want to learn more, I would recommend you go check out the SIBO website. This is the Chicago Board of Options Exchange. There's a lot of stuff on here that you can learn about. And, if you like to trade the VIX, the VIX everyone talks about is the VIX that is on the S&P 500 options. Maybe you could find an option with a cheaper premium if you're, say, looking at buying the VIX on the small cap index. So that is it, everyone. Thank you so much for tuning in. Just wanted to see here if there's a list of all the VIX indices. SIBO, global SIBO indices, main channel. So check this website out, and you can kind of scroll through here, and you can find all different types of indices that you can trade. So again, the VIX measures how much people are willing to pay on the insurance to get into S&P 500 options. But there's also a lot of other VIX indexes out there. Let's go see here. Oh, look at that sentiment index. That's pretty interesting. All right. Well, I should have probably thought this out a little bit more before I made this thing here, but made this presentation. But I was just watching on one of these, finance shows. They're talking about how the VIX is the fear index, and I just want to put out a little bit more information of what it really is, because what we do at the Stock Market Jobber is we try to educate people. All right, thank you, everybody. Thanks for tuning in, and I will see you soon.